Imagine a financial system, just enormous, where billions, no, really trillions of dollars zip across borders every single day. It shapes everything. Now, what if I told you that a huge piece of America's own financial backbone, its federal debt, isn't actually held by Americans? So who is holding the biggest slice? And maybe more importantly, why should that matter to you? That's the really fascinating question we're digging into. We're going to try and cut through some pretty complex economic numbers, pull out some surprising insights about this whole global financial setup, and we're basing this on a really critical Congressional Research Service book that shines a light on it all. Speaking of getting clarity on complex stuff, just a quick reminder about our Mindful Moments initiative. Do check out our YouTube channel. We're using AI book analysis over there to help spark reflection and, rational thought on tough subjects just like this one. It's really about getting to the core, minus the usual noise.
Okay, so to really get a handle on who holds this debt and why, we first need to maybe lay down the basics. What is federal debt? Well, simply put, it's just the running total, the accumulation of all the money the federal government has borrowed over the years. But there's a key difference here. You hear about gross debt, but what really matters for the economy is debt held by the public. That's the debt bought and sold in markets. It's the stuff that influences interest rates, private investment, the real economy. Okay, so debt held by the public, what form does that take? Is it just like a giant IOU note somewhere?
Well, sort of. It's mainly marketable U.S. Treasury securities. Think of them as, very liquid IOUs from the government. These come as short-term things called bills, medium-term notes, and longer-term bonds. And they're sold off to all sorts of investors. People here, people overseas, individuals, the Fed itself, banks, big institutions, and foreign governments too. That's key for our chat today. Right. So, keeping that in mind, let's talk scale. Because the numbers are just huge. As of December 2023, we're talking $26.2 trillion in Treasury securities outstanding. Just to give you some context, back in December 2019, that was $16.6 trillion. That's almost a $10 trillion jump in just 4 years. It's kind of mind-boggling.
It really is. And here's where the book throws up the first real surprise for me. Foreign holdings, they did go up during that time by about $1.1 trillion, reaching around $8.1 trillion total. That's a lot of money. But their actual share of that publicly held debt, it went down quite a bit, actually. It dropped from 42% back in December 2019 down to 31% by December 2023.
Wait, hold on. So foreigners bought more U.S. debt, like in raw dollars?
Yep, $1.1 trillion more.
But their slice of the total pie got smaller. How does that even work? That feels bad.
Exactly. It is counterintuitive, right? But that's what happens because the total amount of U.S. federal debt grew even faster than foreigners bought it up. So they bought more, but the whole pie just expanded much, much more quickly. So their percentage share naturally fell.
Wow. Okay, that's a really important distinction. And that huge amount of debt, whoever holds it, it costs us, right? There's a real price tag for U.S. taxpayers.
Oh, absolutely. In 2023 alone, the interest payment sent overseas just to foreign holders was $197.5 billion.
Almost $200 billion. So who exactly are we sending this money to? Who are the biggest foreign holders country-wise?
Well, before we get to the specific countries, it's useful to know how these holdings are tracked. The book breaks it down into two main types. Official and private. Official means governments think foreign central banks, maybe sovereign wealth funds, public institutions. Private is, everyone else. Private banks, companies, investment funds, even individuals. As of late 2023, it was pretty close to a split. Official holders had about 48%. That's $3.8 trillion. Private investors held the other 52%. Around $4.2 trillion. So it's definitely not just governments buying U.S. debt.
Okay, that's helpful context. So within that mix, who are the big players, the top countries?
Right, the top estimated holders as of December 2023. Number one is Japan. They held about $1.1 trillion. That's roughly 14% of all foreign investment in treasuries.
Okay, Japan at number one.
Then comes China, holding around $0.8 trillion, which is just over 10%. But what's really interesting with China, as the book notes, is that their holdings have actually been falling, both in dollar terms and as a percentage of the total foreign held debt since 2019.
So China's share is shrinking. And who's third?
The United Kingdom. They held about $7.7 trillion, which works out to around 8.5% of the foreign total.
Japan, China, UK. Got it.
But there's a really important footnote here, something the book makes clear. These numbers are based on where the securities are held or managed, like the location of the custodian bank, not necessarily the actual final owner's nationality.
Okay, so that explains.
Exactly. It explains why you sometimes see major banking centers, places like Luxembourg, Ireland, Maybe the Cayman Islands show up pretty high on the list. It's where the money is managed, not always whose money it ultimately is. It adds a layer of complexity.
That makes a lot more sense. It's not just a straightforward list of countries. Okay, now this is where I think it gets really interesting. The why. Why does this happen on such a massive scale? The book points out that for decades, the U.S. as a whole, we've saved less than we invest. And when the government runs budget deficits, that pushes our national saving down even further.
Right. And basic economics tells you if your domestic savings aren't enough to cover your domestic investment plus government borrowing, well, that money has to come from somewhere else. You have to borrow it from abroad. It's almost an accounting identity.
And this ties directly into the trade deficit too, doesn't it? The thing we hear about all the time.
It absolutely does. To be a net borrower from other countries, meaning we're taking in more capital than we send out, we must also be buying more goods and services from them than we're selling to them. That's the trade deficit. And the numbers back this up. Since the year 2000, both U.S. borrowing from abroad and the trade deficit have consistently been over $300 billion every single year. They move together.
Okay, so we borrow from abroad partly because we don't save enough, and that's linked to running a trade deficit. Now, intuitively, that sounds maybe not great. Borrowing huge sums, sending interest payments overseas.
Yeah, that's the initial reaction for many people. It sounds like a burden.
But here's a twist the book explores, a kind of counterintuitive positive angle. What if that borrowing actually helps the economy? Say, if it fuels a recovery or gets productively invested in the U.S., adding to our capital stock. The book suggests in those cases, the U.S. might actually end up better off overall, even with those interest payments going abroad.
That's a really key point. Think about what happens without that foreign borrowing. If the government is running big deficits and only domestic savings are available to fund both that and all the private investment happening.
Interest rates would have to go up, right, to attract those limited domestic savings.
Exactly. You'd likely see much higher interest rates across the board. That's the crowding out effect. Higher rates mean businesses invest less, fewer projects look profitable, and that leads to slower economic growth, lower GDP over time. So the ability to borrow from foreigners, it actually helps prevent that severe crowding out. It keeps U.S. interest rates lower than they otherwise would be. It reduces the government's own borrowing costs, and it lessens the negative impact of the deficit on the wider economy. Even though, yes, some income flows overseas, it's like a relief valve.
So foreigners buying our debt helps us avoid shooting ourselves in the foot with super high interest rates caused by government borrowing. That's a different way to look at it. So what drives this huge ongoing demand for our debt, for treasuries? Why are they so popular globally?
Well, one big factor, especially during crises, is the flight to safety phenomena.
Right, we saw that in 2008, and again with COVID, didn't we?
Absolutely. When things get scary globally, investors rush into U.S. treasuries because they're seen as incredibly safe. There's almost zero perceived risk of the U.S. government defaulting. Plus, they're super liquid. You can buy or sell them really easily, quickly, and cheaply, unlike almost any other asset in the world. It's the ultimate safe haven.
Okay, so safety and liquidity are huge, but there's something more fundamental too, isn't there, about the dollar itself?
Yes, definitely. The U.S. dollar's unique position as the world's main reserve currency creates this sort of permanent underlying demand for treasuries. They're essential plumbing for the global financial system. They're used as collateral for all sorts of international transactions, trade financing, derivatives, and central banks, companies. Everyone needs to hold dollars for international business, and treasuries are the safest, most convenient way to park those dollars.
And what about foreign governments specifically? You mentioned they hold a big chunk. Are there reasons different from, say, a private investment fund?
Yeah, often slightly different motivations. Foreign governments, like central banks, are usually looking for a super stable and liquid place to hold their foreign currency reserves. They might use these reserves to manage their own currency's exchange rate, maybe intervene in markets, or it could be a way to reinvest the proceeds from large export surpluses. Sometimes it's just about building up a financial cushion, a war chest, for economic stability back home. So for them, the rate of return, while not irrelevant, might be secondary to just having that safety and easy access. Liquidity and stability are often the top priorities.
Okay, so there are clearly some benefits, or at least ways this system helps stabilize things and keeps borrowing costs down. But it can't all be positive, right? What are the downsides, the burdens, or risks for the U.S. that the book highlights?
No, you're right. There are definite burdens. We already mentioned the big one, those income transfers. Billions in interest payments flowing out of the U.S. economy every year. Then there's the connection to the trade deficit. The strong demand for dollars to buy treasuries can keep the dollar stronger than it might otherwise be. And a stronger dollar makes U.S. exports more expensive for foreigners and imports cheaper for Americans, which can put pressure on exporting industries and companies competing with imports here at home.
And the long-term burden.
And the big long-term one is simply the burden on future taxpayers who will have to service this debt through continued interest payments or eventual repayments, borrowing from the future, essentially.
And the book mentions the U.S. has been a net debtor nation since way back in 1986. The total net foreign debt was almost $20 trillion in 2023. But it also points out something interesting. The U.S. typically earns more on the assets it holds abroad than it pays out on its foreign debt. So is that net debt figure really the big worry?
That's a really sharp point the book makes. Historically, yes, the U.S. has earned a higher return on its foreign investments than foreigners have earned on their U.S. investments, including treasuries. So the current income flow isn't necessarily the crisis point. The real concern is about the sustainability of the growth in that net foreign debt. If it keeps ballooning unsustainably, eventually foreigners might start to rethink holding so many U.S. assets. They might lose confidence or just want to diversify away. If that happens suddenly, it could trigger financial instability, maybe a sharp rise in U.S. interest rates, a rapidly falling dollar. That's the potential long-term risk working there.
So it's more about the trajectory than the current snapshot. Okay, so if policymakers did decide this foreign ownership was becoming too risky, what could they realistically do about it? Could they just stop foreigners from buying treasuries?
Well, the book suggests that's extremely difficult, probably impossible in reality. Treasuries trade on huge global secondary markets. Trying to enforce a ban would be incredibly complex. Money finds a way. And even if you could, it wouldn't fix the underlying economic reason why the U.S. needs foreign capital in the first place. Foreign investors would likely just shift to buying other U.S. assets like corporate bonds or stocks. It doesn't solve the root cause.
Right. You're saying the issue isn't really the foreign ownership itself, but the thing driving it, that gap between U.S. savings and investment.
Exactly. That's the fundamental issue. The foreign borrowing is more of a symptom or maybe a consequence of that deeper imbalance in the U.S. economy. Tackling the ownership without tackling the cause doesn't really get you very far.
So if that's the root cause, what's the main solution the book points towards for reducing this reliance on foreign money?
The most direct way, according to the analysis, is for the U.S. to increase its own national saving rate. And the most direct lever the government have to do that is by reducing its own borrowing. That means smaller budget deficits. If the government borrows less, there's less need to pull in capital from overseas to fill the gap.
Yeah.
But there's a crucial caveat. The book also cautions that cutting deficits too aggressively, especially during a weak economy, could backfire. It could slow down recovery. So it's about finding the right balance and timing.
Right. It's not a simple on-off switch. So there we have it. This whole issue of foreign holdings of U.S. debt, it's really complex, isn't it? Lots of different angles, significant economic consequences, challenges, but also some maybe unexpected benefits or stabilizing factors. It's definitely not just black and white.
Absolutely. And if you zoom out, think about the bigger picture. It really raises a fundamental question for the country, doesn't it? How do we balance our need for investment, for economic activity right now, with the long-term sustainability of our national debt, especially knowing so much of it is held globally? That's a huge ongoing challenge.
So what does all this mean for you listening right now? Well, it means realizing that these huge abstract numbers, trillions in debt held overseas, they're actually deeply connected to your own financial world. They influence interest rates, the value of the dollar, job prospects in certain industries. They connect to the strategic choices that shape all our futures. And helping you navigate and understand these kinds of critical topics with clarity, that's exactly why our podcast exists, including the Mindful Moments insights you can find over on our YouTube channel. We aim to distill this complex information so you can really get informed. We really hope you'll subscribe to The Deep Dive wherever you get your podcasts so you don't miss our future explorations. And if you found this interesting, maybe share it with someone else who's curious about how global finance actually touches their lives. And hey, if you really want to go deep, the original Congressional Research Service book we've been discussing, we've put a link in the show notes. You can check it out for yourself, do your own critical review. And as you go about your day, here's a final thought to chew on. In this totally interconnected global economy, what responsibility do we each have to actually understand the force, like these huge debt flows that are shaping our financial world?